Everybody, and welcome back to the Teaching Tax Flow podcast. Today, we are not going to talk about something that you really are opting in to do or selecting out to do. We are going to talk about when you elect out of bonus depreciation. So you've heard us talk about this a whole lot, exactly, what bonus depreciation is, how it's back on the table because of the One Big Beautiful Bill Act, big change that we saw last year carried through into this year, so 2026. And we're going to get into a detail. So we're going to kind of condense this down for you a little bit. We're going to make it clear, concise, and actionable for you if you're ready to do so. And I couldn't think of anybody else better to do it with me than Chris McCuro. Welcome back to your own show, sir. How's it going?
It's going well. How are you doing?
Doing good, man. I'm excited. This is one that, we're not telling people that they have to, like I said, opt into something. This is something you're opting out of, correct?
Right. And bonus depreciation it was a super hot topic with the One Big Beautiful Bill Act. Remember, with the Tax Cuts and Jobs Act, bonus depreciation started at 100%. And what bonus depreciation is, it's a wrinkle in the tax code, the federal tax code, that gives you a temporary accelerated deduction for any eligible assets that you purchase. That could be an eligible vehicle. That could be a piece of equipment. That could be part of real estate if you do a cost segregation study, any personal property. Excuse me. So several assets fall into this bonus depreciation eligible bucket, for lack of a better term. And with the Tax Cuts and Jobs Act, bonus depreciation, like I said, was set at 100%, but it started scaling down, and ultimately it was going to go bye-bye. In the One Big Beautiful Bill Act, threw around life support and made it permanent for now, of course. Everything, even permanent things in the tax code could be temporary. So this incentivizes business owners and real estate investors to put their money into buying assets. So that's the incentive. And it could be a huge incentive. And for the 2025 tax year and the 2026 tax year, that bonus depreciation percentage is 100%. Meaning, I purchase a new piece of farm equipment. Assuming that farm equipment is 100% business use, I could deduct the entire piece of equipment year one, which is a huge incentive. Now, what does that do for you? Well, it reduces your tax based on whatever your marginal tax rate is. So bonus depreciation, remember we talked about Section 179. We're going to have another episode on Section 179, the cousin of bonus depreciation. But what you have to understand with bonus depreciation is it's automatic. So you are going to receive the bonus depreciation deduction by default on your tax return if you have eligible property.
And I know when this was going to go away, right? I think the biggest oh crap moment, right? Is a lot of real estate investors were like, oh man, like there goes one of the best things I can possibly have for now. And like you mentioned, equipment. So I think I'm grateful that you explained what it is too. And then also, why is it that you have to elect out of this thing? Well, that's because it's going to be automatically implemented or executed, right? You have no say in that except to say you don't want it.
Absolutely. So here's the good news, because sometimes, if you told someone, hey, you could have as much chocolate as you want, if you're a 10-year-old kid, well, you're going to get a stomach ache, right? So you automatically get the bonus depreciation at 100%. However, you can elect out of the bonus depreciation. Okay, that might work out well, right? Yeah. So when should you elect out of it? And how do you elect out of it? Well, you can elect out of it by attaching a statement to your tax return that you're electing out of bonus depreciation. And the cool thing is you can elect out of bonus depreciation on a class-by-class basis, meaning you might have, as a business owner, real estate investor, 5-year property, 7-year property, 15-year property. When I say 5, 7, and 15-year property, that means that's the class life that the IRS has assigned to that property, and that's how long it is depreciated or deducted by default. Okay, you could say, you know what, I'm going to take bonus depreciation on all my 15-year asset class property and elect out of it on my 5-year property and spread the 5-year property over that 5 years. So it gives you flexibility. Not just can you elect out of it, you can elect out of it on what we call a class-by-class basis. Now, when would you want to elect out of this? Well, remember, tax planning is based on legally and ethically reducing the tax you pay in your lifetime and paying the lowest marginal tax rate possible. So if you are in a tax year that you're already in a very low marginal tax rate, that might make sense to elect out of the bonus depreciation. So the number one reason is going to be tax bracket management. I either can get let's say the deduction's $100,000. Remember, a deduction multiplied by your marginal tax rate is your tax benefit. So if your marginal tax rate is going to be higher in a future year than the current year, that's when it makes sense to potentially elect out of the bonus depreciation and just take your depreciation deduction or your cost recovery over the longer period of time. All right. You also might want to time it when you could take a loss. So for instance, let's say you are real estate professional status. Let's say you in this year, but you're going to change careers, you're going to change your activities, and you're not going to be a real estate professional status next year. You might want to do a cost segregation study this year and take the bonus depreciation. But what if it was in reverse? You might want to elect out a bonus or run the cost segregation study in the future. Or if the deduction is just more than you expected on a cost segregation study. So again, you want to align it with your marginal tax rate and make sure that the year you're taking the bonus depreciation is the year that it can most benefit you. I'll use another example. At the end of the year, you purchase a vehicle eligible for bonus depreciation. That vehicle is $60,000. Your business profit is $20,000. You decide, you know what? I really don't want to take all $60,000 deduction this year because I want to have deductions in the future years when my business is going to grow and I'm going to be in a higher marginal tax rate. Then you'd probably want to elect out of it. And one big misconception is that the depreciation deduction is tied to your cash. So remember, one of the three laws of tax planning, tax flow and cash flow are different. So back to my example on that $60,000 vehicle. If you paid cash for that vehicle, or if you finance the entire thing, the depreciation deduction is not affected by it.
This podcast is brought to you by Strategic Associates. Are you a high-income earner, real estate investor, or successful entrepreneur who is frustrated by having to pay $75,000 or more of annual tax liability? If so, Strategic Associates can help. Your first step to saving thousands, if not hundreds of thousands, is to contact Roger Roundy at roger@strategicag.net or by calling 801-641-2956 and be sure to tell him TTF sent you.
One of the reasons you might want to elect out of it, it might be, I financed a big portion of this piece of equipment or this vehicle. I want to match that depreciation deduction in a similar fashion to when I'm actually paying for it so that years 2, 3, 4, 5, 6, when I'm basically paying for a piece of equipment or a vehicle that I'm using, I'm actually getting a deduction in those years also.
And you answered some really good questions there that I do want to reiterate before we move on too far. I'm sure we'll talk about exactly, maybe how do you elect out of this a little bit. But the two things that I took away from that I'm sure a lot of people are thinking of is, well, how do I know if I need to elect out? How is it going to benefit me? Which you answered, obviously, tax planning. That is direct as it possibly can be. That is the answer. That's your guide, right? That's your blueprint. But then also, I'm sure a lot of people are thinking that, well, why would I not want something that's great, right? Like you guys are always telling me how to make it better or how to get more or do something with it. Why would I say I don't want this? And you explain that very well, right? Like through tax planning, now you know when you can actually take it and benefit from it most, right? So it's almost like, hey, instead of turning away a I don't know, I'm not a steak guy, but a 10-ounce steak. Oh, well, I don't want that. I only want half of it. Or, I'll save a little bit for, every time I'm hungry year over year. You're in total control of it at that sense. So I appreciate you breaking it down that way.
Oh, yeah, and you brought up a good point. How you elect out of it, I said you attach a statement to your tax return. So that's the point. When you purchase the equipment or vehicle or whatever you're purchasing, again, doesn't matter if you finance it or pay cash. You make that election when on a timely filed tax return. So you're not obligated to take the deduction when you buy it. You're not telling, hey, I'm at the automobile dealership, I'm electing to take bonus depreciation. No, that all gets decided when your tax return is prepared. And that's why it's good to work with a tax professional that understands that. And that tax professional should be asking some questions, but as tax professionals, we're not mind readers. You should be letting the tax professional know, you know what, I had a good year in business this year. I had a big contract come in. Next year, I'm going to tell you, maybe my child's a senior in high school. I'm not going to work as much. My income's going to be a little lower. That tells me to take more deduction this year versus, yeah, I just started my business. I had a good last quarter, but man, next year is going to be crazy. That tells me maybe elect out a bonus this year and give me more deductions for next year when they could be used in a higher marginal tax bracket. Now, you also have to consider not all states honor bonus depreciation. So you could have two separate deductions. Many states still make you use what's called MAKERS, which is a modified accelerated cost recovery system. In other words, depreciate the deduction over the course of time. And you've got to look at your marginal tax rate. Your marginal tax rate includes, and we have a lot of content on this, are you getting phased out of tax credits? Are you getting phased out of deductions? We don't want to waste deductions. Are you getting the 199A deduction anyway? So bottom line is fitting the bonus depreciation deduction in the tax year that you think is going to be most beneficial to you. And if you're in a tax year that deduction is not going to be as beneficial, then elect out of it. The best way to wrap this up is that I could describe this is this, John. We like to travel and we talk planes, trains, and automobiles all the time. I like to drive, but here's the way I would talk. I want you to think about this. Let's say you live in Detroit, Michigan, okay? And you are going somewhere. And I say, would you rather fly or drive? By default, most people would say, assuming the cost is the same, right? I'd rather fly rather. Okay. What if I said you're going to fly from Detroit to Flint? That drive is about an hour and a half, depending on who drives. But let's say about an hour and a half, right? With no traffic. Even if a flight was the same price as driving, you're going to get there faster by driving because you've got to check into the flight. You've got to get a rental car when you get there. You've got to fly. You've got to taxi. But see what I'm saying? But if I said you're going from Detroit to Dallas, Texas, a flight's more efficient. A flight saves me time. So the same thing with the bonus depreciation. If it's in a year that's saving you a lot of tax dollars, use it. If not, elect out of it.
It's a great way to explain it there. And back to the whole tax planning thing, right? And again, another great point. I know that you hit this, but even if you're working somebody to create a tax plan, they can't forecast everything that's going to happen next year. So it all breaks down to that relationship, right? Like how much are you sharing with them? How much, you can only forecast so much stuff. And I'm going to leave it with this one, actually, Chris, if you're good with that, is, we created something at Teaching Tax Flow called the Hub. We've mentioned it a couple times, but I guess this could be maybe its formal introduction, releasing this thing in the world. Think of this as your best friend and helping you find the best context to really help you get the best result possible, right? So what I mean by that is you check the things that you're interested in, and we will send you introductions to those people. Plain and simple. We're not being sold anywhere. It's cut and dry, right, Chris?
Absolutely. And I'd be remiss to say, I'm going to tie this into the Hub. The Hub is a way for you to connect with partners within the Teaching Tax Flow community that we have the utmost confidence in. And finally, on bonus depreciation, I should have mentioned this. If you have a partnership or an S corp return and you have other people or owners in that return, that entity, you want to coordinate with them before making any type of bonus depreciation elect out decision. So, please jump into the Hub. Thanks so much for the time. This has been the cousin of a bonus depreciation is coming down the pipeline. It's called Section 179, and we might have an episode 179 coming up as well. So appreciate you all and have a great day.
I do believe that's the case. So as Chris mentioned, thank you everybody for joining us here on the Teaching Tax Flow podcast. We'll see you again here back on the show next week. Different date, completely different topic. Have a good week, everybody.
The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum.